and the financial and professional services industry. I believe your team in the office is Connect to Prosper, which brings together thought leaders from scientific, academic, and business worlds to demonstrate the city's strengths in solving global issues. So with that, I hand you over to Michael, and Michael has to leave us after he finishes. So we're going to try to do a quick little Q&A before we have to say goodbye to Michael and bring the rest of the panel up. Thank you.
Indeed. Well, good afternoon, ladies and gentlemen, and it is a pleasure to be able to join you here at this important and timely summit. I think we're seeing a reevaluation of the blockchain world from the first 10 years of sort of just throw blockchain into every conversation, and I'm sure something will result. As Jeet said, I am the 695th Lord Mayor, and I lead the City of London Corporation. For those of you not familiar with it, we are the governing body of the Square Mile, and we are actually at nearly 1,400 years old, the world's oldest democratic workers and residents cooperative. We've been holding elections since the middle of the 7th century, and I am absolutely delighted to be here. And one of the things that you may not be aware is, apart from my mayoralty, my career does span finance and technology research, including work on digital currencies and smart ledgers. And in fact, I think I built my first blockchain in 1995, and it's still running, and it does about 1 trillion transactions a day if you push it. So I have a very somewhat scathing view of many of the things that I hear about and read about. Before going further, I think a few things just might help you. What is the City of London? Well, technically, we are the square mile. We're neither square nor a mile. We're about 1.12 square miles, and we're sort of oblong. But the truth is that we represent 615,000 workers, generating some 10% of GDP off of 2% of the national workforce. Yes, those are all true. And we are about a third finance, but we're actually a third science, engineering, and technology. Remember, the city is home to the New Learning in the 15th century, Gresham College in the 16th, the Royal Society in the 17th. So we have about a third of our workforce in science, engineering, and technology, about 8,000 of our 24,000 businesses. So a few points I might make. First, before going further, too many in the city really fail to adequately distinguish between blockchains and crypto assets, talking about them as if they're interchangeable or synonymous. And of course, I know many of you are quite informed. And it reminds me today of the joke about Batman, who was hearing about these potentially transformative technologies and the impact that they would have. And he decided to convene his fellow superheroes to discuss the blockchain. Unfortunately, Superman was a bit confused and couldn't attend. He heard it was kryptonite. Yeah, so you'll get faster by the end of this. Yeah. But seriously, smart ledgers, also known as blockchains, are just multi-organizational data structures with a superb audit trail, and if you want to stick it in, some embedded code. It's actually been around for decades. I'd point you to a paper on my website called Prior Smarts, where I had a bunch of Imperial kids working for me about 4 years ago, and I had a huge 20-minute argument with them about checksums versus hashes, and when I finally convinced them that they really are the same thing, it's just a difference in length, they unearthed actually a 1976 IBM patent on a blockchain. So it is not new. It's a boring old structure. It's a terrible thing. And much of the things that we go on are circular. You've got all these exchanges which are running effectively centralized databases, but they're running centralized databases to exchange things between really boring ledgers. It's a really complicated field, and we have been struggling, I think, frankly, because we've been deluded by making some smart, quick money is the idea. Now, so my focus is really not on cryptocurrencies. I have absolutely no objection to cryptocurrencies whatsoever. If you want to exchange gambling tokens, be my guest. That's your business. And I really mean that. I have absolutely no moral compunction whatsoever about it, but I don't see it as a particularly useful economic purpose. On the other hand, I do believe that we have an opportunity to resolve portions, not all, portions of the central third-party problem. And these are the areas that I'm interested in, which is identity, document exchanges, agreement exchanges across a plethora of areas: shipping, media, law, health, IP, life sciences. Now, Mark Twain said that the secret to getting ahead is getting started. And I'm very interested in some of the thoughts that were coming up at the session at the end. where the EU has made, I think, a sensible start in the form of its markets and crypto assets regulation, MiCA, as we know it. And it is, in fact, the first major jurisdiction to try and introduce a comprehensive set of tailored rules for the sector. And I think that is a very welcome step because they're really trying to get their head around it. And as you know, these new regulations, hopefully coming into effect this year, will provide the legal certainty and clarify the rules of the game on the continent. And for its part, I would point out that the UK government has also made progress, bringing, as you know, as we said in the earlier session, some stable coins into the regulatory perimeter via the Financial Services and Markets Act 2023, and proposing a swathe of regulation for crypto assets in general. Now, we in the city were very much supporting. In fact, we provided the Secretariat for Ron Khalifa's 2021 FinTech review. So we are anxious. We have an ambition to ensure not that we become a global hub for the crypto and digital assets industries, but that we remain the hub for the crypto and digital assets industries. And so we are very anxious to do that, so long as those are economically productive areas providing benefits to society. Every time we've gone down the get-rich-quick road, we've come a cropper. And so I think it's very important that we keep maintaining the idea that these are good. They should not be resisted. They should be supported. But we also need, I think, to call out ruthlessly when they're not doing it. And in fact, you know, some of the things that you've heard, do you remember all the statements you've read about Bitcoin for payments or cryptocurrencies for payments? Do you remember all the stuff you've read about it's a store of value, right? Well, I remember a boy who asked his father for $10 worth of Bitcoin currency. $9.45, replied the father. What do you need $10.11 for? And at that kind of volatility, it clearly isn't performing the functions that we claim money is supposed to provide. Now, one big thing that I think is overlooked as we focus on MiCA and some of the other things around the world is, in fact, the fact that we've been somewhat deluded by the law firms and, to be frank, some of the accountancy firms in the sector. I have, since they finally woke up 5 years into Bitcoin. Bit and coin might have something to do with our industry. We've had 10 years now of conferences talking about regulation and how difficult it is to contract. And please pay my law firm as much as you feel like so that we can think about it for you on our time and on our timesheets. Well, that's interesting stuff. But what we forget is the strength of the common law system. And I helped Jeffrey Voss, who was master of the rules a few years ago, and he made this clear in his work on smarter contracts with LawTech UK. Our common law system requires no adjustments to accommodate digital assets. None. So why do we talk about regulation all the time? Right? There are certain areas where it's there, but we can do most of the stuff that we think is exciting without actually dealing with regulation. The common law system can handle most of it. And as a piece of evidence, I would point you to the fact that the Electronic Trade Document Act, which tidied up all of the little things that needed tidying up to make that common law assertion true, is only 5 pages long. Well, 6 if you count the cover. So in other words, common law is one of the best systems in the world. Now, as the first major nation to give equal legal standing to electronic documents rather than just paper bills of lading, I think the UK is really, really well poised. Some of you will be familiar with what The Economist dubbed in 2018 pulp friction. They followed a shipment of avocados from Mombasa to Rotterdam, which entailed more than 200 communications involving 30 parties. It's pitiful, really. Full of pits, an area ripe for reform. But it serves as an example where actually I think blockchain has far more to provide than up and down scams on a market where over 2/3 of the coins that are issued are outright scams. And the other third are not proven not to be. They just haven't been proven ab initio. So ETDA, electronic trade documentation, is, to me, one of the biggest areas. And you can see, in particular, in the Maersk and IBM collapse, which some of us predicted the day it was launched, what happens and what matters is not having a monopoly. The amazing thing about blockchain is the fact that it is a shared ledger. So if you're not sharing the ledger freely and helping people to connect via standards, you really shouldn't be talking about it. So cheaper, simpler, faster, more transparent, secure, reducing trade costs, speeding up transactions, mitigating error, and bringing about, hopefully, some considerable environmental benefits. That is what I see blockchain being about. There are a number of other areas that we do need to work on. One that I've been focused on, you may have seen me in the press yesterday, is on the unified payments interface with India in particular. We in the United Kingdom have to start, I believe, being even more assertive about international standards. So in that case, I'm looking at ISO 20022, which intriguingly, for a country that claims to be a fintech hub, we are at least 4 years off of implementing an international standard that most other nations are using. It's cutting us off from connecting in payments with a seventh of the world, India, 2.1 million people from the Indian diaspora here. And why would I set up a fintech in Europe, in London, from India, when I should be setting it up in Paris, where at least they're connected to my national system? So there's a lot of things that we need to do. And I think these equally apply to blockchain. We should be pushing much harder the international standards arena, the ISO standards, because if these are truly going to be global international statements of ledger, statements of state for that matter, then we need to ensure that we are promoting them as widely as possible in the international community. Now, as Jeet said, my mayoral theme is Connect to Prosper, and I'm trying to connect the many areas, the many knowledge miles that flow through our square mile. Because while the city is known for all of that leadership in financial and professional, it's equally known for the 40 learned societies, 70 universities, and 130 research institutions, which exist just within 2 miles of Guildhall. Now, I've got a number of projects underway, and I'll rattle off 4 quickly, just so you know what they are. We have a mental health project called Galanos. We have a constructing science initiative on life sciences. We have an area where we're looking at space protection using space debris retrieval insurance bonds. And so we're doing a lot of different projects, but there are 2 that might interest you in this session, and perhaps we can touch on Q&A if they are. The first is the Ethical AI Initiative. The 695th Lord Mayor's Ethical AI Initiative is doing 2 things. We launched a course 23 weeks ago, which has been taken by over 4,000 people in 45 countries, including 7 regulators and 4 central banks. And what we're pushing again are the ISO standards that already exist and have existed for years. So in all the discussions that you've ever had, next time you see somebody on a stage pontificating about AI and regulation, ask them to name the 4 ISO standards that already exist. And if they can't name them, would you tell them to get down and do their homework first before they get up there and talk on Radio 4? The second thing is we have something called the Smart Economy Networks Initiative. This is using the International X-Road standards. I would encourage those of you to have a good look at it. This is an open source system that's been available for over 20 years. It was Estonia's gift to the world over 25 years ago. After they got whacked by the Russians, they decided that they wanted to do this. We now have 30 firms in the city finally trying it and going, my gosh, this is absolutely wonderful. You know, why are we creating new networks and new systems? This handles document transformation, identity, and recording. And yes, it's on a blockchain. Unfortunately, the Estonians invented all this before we came up with the term blockchain. So it's all actually up and running, and I would encourage a good look at those. Now, as you know, the economy of the last 20 years has been driven by mobile, social platforms, and the cloud. I think it's fairly safe to say that smart economy networks will be driven by artificial intelligence, open data, shared ledgers, and hopefully shared identity. But I believe that the City of London is, in fact, the world's coffee house, and you're exemplifying that today by being here and discussing a subject. And I think that's what it's all about. At the end of the day, we here in the City of London are the place that the world comes to find solutions to its problems because we can assemble a multi-diverse community to address them. Fundamental to success, I think, is an area we frequently forget. It will be enforcing the principle that individuals own and control their data. I think that's an important bit at the core of many of the failures. I was heavily involved in the open banking project and resigned from it because it lost its set of principles. And I think you can see how hampered it has been because it lost those principles. And to make all of this work, as I've emphasized, we need standards, and by which I really mean software, not hardware. So hopefully, at the end of the day, money and advance seems to advance in what those who study the history of science call punctuated equilibria. It means things persist for a very long time and then suddenly jump, almost for no reason. And I would remind you of Sumerian clay tablets, Egyptian papyri, Lydian gold, Chinese paper, medieval tally sticks, one of my favorites, metal currencies, gold standards, central banks, and digital services. And I think we are all here because we all feel we're on the cusp of a revolution if we're not quite sure what it's about. So when that equilibrium is punctuated, we will find out, I'm sure. The French writer and aviator Antoine de Saint-Exupéry, the famous Little Prince, said, "A pile of rocks ceases to be a rock pile when somebody contemplates it with the idea of a cathedral in mind." And I think blockchain is inherently boring. My most viewed video on YouTube is "Blockchain is Boring" from about 10 years ago. But it can cease to be boring because the sum of its parts, through things like hashes and other boring cryptographic materials, through targeted and proportionate regulation, the thrill of regulation, all of that is going to give customers, clients, and investors confidence that it is boring. And when it's boring, it's going to be most successful. So I ask you to join with me in connecting to prosper in this area. And I laud all of you for being here and discussing the topic today. Thank you.
Thanks. Thank you very much for your time, Lord Mayor. We've got a few minutes for some questions. We can take some in the room, and we can also just take a couple on the screen as well. Firstly, in the room, we've got a question here right in front.
Well, Mayor, that was an amazing speech. It touched a number of very, very important issues. One thing I will say is I'm proud to be British, and I know a lot of my comrades have gone down to Dubai for Token 2049. They've gone for Dubai for this week, and Dubai is actually doing a lot of activity, and a lot of the intellect has come from the UK. And I stress that more importantly than ever before. One thing that always surprises me is that we haven't had a major week of pushing conferences in this space. We've got Tech Week, which is very, very general, very Web 2 based, but we definitely 100% need a blockchain focus, because you've got blockchain in metaverse, you've got a whole load of other new evolutions, and 99% of the people in this room are advocates of this growing economy, and it is growing exponentially. But you've done a fantastic job. Thank you.
Thank you, Bobby.
Thank you very much there. Any other questions from the room before we have to say goodbye to the Lord Mayor and we bring the rest of the panelists up? Any other questions? Oh, yes, we've got one over there.
Thank you so much. And it was so wonderful. So many reality checks along the talk. My questions would be primarily regarding the adoption of blockchain into the government use cases. I come from India, where we are piloting blockchain for health records and land records and birth certificates. So similarly, can you just talk about some important initiatives that you are hopeful for, where you predict success, opposite to what you predicted for Maersk and IBM, but where can you predict success over here?
I believe you've hit a very important point. If a government really wishes to make itself a blockchain center, it should be using it. You eat your own dog food kind of thing. So as much as I applaud conferences and marketing, and I really do, so I'm not doing it down, I think a government that starts to use it is absolutely superb. Let me give you a very odd answer, which is one of the weirdest things in Britain is if I apply and get my driver's license, I don't get a certified digital copy. Why don't I get a certified digital copy of all of my government interactions? Well, somebody might fake it. Well, all they're going to do is photocopy it, take it down to an actuary who's going to write by hand, this is a certified copy when it's not really, and then certify it and hand it back to me. This is insane. And so that's a start. Now you're going to say, well, that's not a blockchain, and it's not. But that's the start to it, is to say that almost all authorized government interactions ought to be certified on a blockchain. All a blockchain is an authoritative timestamp. And why can't the government timestamp all of its interactions? And so I think that would be one of the biggest things that could possibly happen in the nation. And I would start there, and I completely agree with you. And so we could begin with the land registry, and if you do poke at a number of things, land registries, share registries are very interesting. Approximately 3 to 5% of share registry entries are wrong. Land registry is a very interesting one. You start poking at the amount of unregistered land in the UK, and it turns out to be quite a significant percentage. And so I think tidy up your own house first. And I would agree with you. And from that base, you could do quite a bit of work. So we're both simpatico on this one.
Well, thank you so much, Lord Mayor, for your time. It was lovely to have you. Thank you for your insights, and thank you for spending your time to join us today.
Okay, great.
So ladies and gentlemen, we are now going to move on to our 3 further panelist members who I'm going to kindly invite onto the stage to join me. We're going to be joined firstly by John Whelan from Santander. John's a leader on Santander's crypto and digital assets at the Corporate Investment Bank. He's had over 10 years of experience and led various blockchain projects, and it's no stranger to the conference, having joined us here last year as well. It's great to have John back, and he's going to be talking to us about giving us his views on the topic there. We then have Amy Kim from PayPal. Amy leads government relations for PayPal's blockchain, crypto, and digital currency business. And prior to that, she served as the general counsel and chief policy officer for a blockchain-focused trade association, building and advocating for its crypto policy platform. So we're great to have Amy on the stage with us. And last but definitely not the least, we have Nicola from Visa. Nicola has been with Visa since 2017 and is currently leading their global go-to-market and product commercialization for Visa's crypto initiatives. His role is to operationalize and deliver their crypto strategy globally. So not an easy task there. So firstly, ladies and gentlemen, just a quick hand to welcome all of our panelists. What the format is going to be, all of our panelists have got a 15-minute session or so that they're going to deliver. And then after each of our panelists have delivered a session, then we'll flop to a Q&A, where we will open the Q&A up to those of you in the room, as well as those of you, the 1,000+ of you, I believe, who've joined us virtually. And hopefully your questions will flash up on the screen in front of me, so I can then put them to the audience. But to kick us off, John, you're happy to sit or to use the podium, whatever is most comfortable to you, sir, but up to you.
I'll tell you what I'll do. I'll stand. I prefer to stand. Very difficult to come after such a fantastic and provocative speaker as Lord Mayor Michael Manelli. It's pretty clear there's a guy who's been doing this work, I think, a lot longer than most of us in this room. I believe he's left already, but I would look forward to the next opportunity I have to have a spirited conversation with him. John Whelan, I'm the Managing Director of Crypto and Digital Assets at Banco Santander. I have been working on crypto and digital assets topics since 2012, which makes me a little bit of an old-timer in the space. Joined Santander in 2016, actually, as the director of one of the very first blockchain labs in a large financial institution. And thank you. I guess I should have switched on the mic that's in my pocket, right? Next time. Okay, so I joined Santander in 2016 as one of the first directors of a blockchain lab in a mainstream financial institution. And back in those days, our work was really around research. You know, what can we do with this inspirational technology that has been given to the world by the open source community, the first of which was Bitcoin in 2009. And I think probably the more transformational fundamentally will be Ethereum from 2015. It launched in July that year. And since then, me and my team, we've worked on a whole variety of financial industry applications and use cases across digital securities, digital cash in all its forms, CBDCs, RBDCs, reserves-backed digital currencies, tokenized bank deposit tokens, stable coins, and of course, crypto, right? Which is where all of this comes from. It's still challenging from a regulatory point of view, but serves as the source of information, of inspiration for nearly all of the practitioners in the space. And we've touched on regulatory topics in nearly every jurisdiction in the world in which Santander operates, mostly Europe, Latin America, North America, and we have offices in Hong Kong and Singapore and other places. I thought what I would do today is maybe talk a little bit about a topic that comes up frequently and sometimes is confusing for people to understand the difference between public chains and private chains. Because if you're writing a smart contract, that little piece of Solidity code or whatever code you're deploying, it's probably the same, whether it's a public chain or a private chain. And in order to think about the difference between the two, I think it's important to go back to first principles a little bit. When Bitcoin launched, Bitcoin gave us 5 things that the world did not have previously, right? Number 1, it gave us the ability to transfer value at a distance. It's commonly not pointed out, but to transfer value at a distance without a central operator. That never existed before. The ability to transfer value without a central operator, of course it existed. I could give you a gold coin or a pound, transferring value without a central operator, but this at a distance was important. The second thing that Bitcoin showed us how to do was how to build a network that had built into its own existence, its own DNA, its own source code, the ability to propagate and secure itself fully autonomously with the most basic economic interactions imaginable. Gambling, as Lord Mayor just said. I don't mean gambling, but playing the lottery of mining, right? Which became proof of work. It also showed us how to directly monetize network effects. You know, this idea of network effect businesses having value. Well, you take something like Google, for instance. If you're a Google shareholder, you have a mechanism to monetize the network effect of Google. But in the case of Bitcoin, because its underlying economic digital asset, Bitcoin, is limited in supply, theoretically, the more users that join the network, the more demand there is for that particular network digital asset, and therefore the network itself and its usage can be directly monetized. And what this led to is, and this was with the evolution of Ethereum, was this idea that you could have these new kinds of networks, and this is really important, where the cost of operating the network is completely externalized to third parties, miners and validators. I mean, the internet's a bit like that, but if I want to deploy a new application on the internet, I certainly don't want to have to build a new internet. And in the world of public chain versus private chain discussion, a lot of times when we talk about deploying a new private chain application, well, first of all, before I build the application, I've got to deploy a new chain, which inside a single financial institution is actually relatively quite straightforward. But as soon as you involve multiple financial institutions, it becomes complicated because you spend the first 2 years of discussions around negotiating the legal agreements and financing arrangements for the consortium that inevitably results. And I think actually what we've seen to date is a large percentage, it's probably north of 50% of the various consortia that have come into being over the past 8 years, at least since my time working at the bank, have probably failed to a certain extent. The Lord Mayor mentioned one, which was the IBM, Maersk,
I wouldn't call it a consortium, but it was like a joint venture agreement or whatever. But it was built on a private permission chain, and there's been a long history of similar failures. There've been a few successes, by the way. Proud to say that Santander is involved in one, which is an attempt to build a multi-currency digital cash wholesale clearing and settling system. It's called Finality International. It's been under the radar a little bit for a long time, but it's live on pounds here in the United Kingdom with hopefully more major currencies coming soon. And the idea that being able to use a public chain seems to be deeply provocative, I think, to parts of the regulatory community now, which are beginning to accept that these new networks are going to come into existence. And a lot of times when my management asks me, okay, John, well, what's the real difference between a public chain and a private chain? I certainly don't want to have to get into this particular level of explanation because by then I've lost the mind share, the bandwidth to make the argument. And fundamentally, I think it comes down to economics, right? So think about what it takes to build, in terms of people alone, a $5 billion financial institution, a bank. I'm going to guess it takes about 10,000 people, just a swag number. Think about what it takes to build a $5 billion fintech. Well, maybe it only takes 1,000 people. That's an order of magnitude difference in terms of efficiency, the resources that it takes. Think of what it takes to build a $5 billion or more DeFi protocol. Let's use Uniswap as an example. It's worth, I don't know, 6 billion or thereabouts. Does Uniswap have 100 people, 200 people working for it? So when I explain the promises or the disruption potential that I see with this sophisticated ledger technology, particularly from the public chain world, as difficult as it is to use in the regulatory environment that we have, I point to the economics or the economic efficiencies that potentially can be realized by the usage of such technology. And I don't care what industry you're in, making widgets, growing apples, farming chickens, or financial services or healthcare. Show me 2 orders of magnitude greater efficiency that is realizable through the adoption or usage of a new technology, and I'm going to point to disruption is coming your way. Simple as that. Now, it might take a long time, but it is pretty much guaranteed to come. And I think actually that's the topic of when public chain versus private chain comes up. Private chains are usable, that's for sure. And we've done a bunch of work, as I've mentioned, in different parts of it. But where the real disruption, I think, will come from, particularly as it relates to the tokenization of assets, will be on public chain technology. Now, let's talk a little bit about tokenization. It's a buzzword that gets thrown around frequently. I can't remember the first time I heard it. Back when I went down this journey 12 years ago now, we weren't talking about tokenization back then. And colored coins popped up on Bitcoin in maybe 2012. Mastercoin, which became Omni, was launched in 2012. The Ripple protocol was launched in 2012. The first version of the Ethereum yellow paper was launched in, I think it was November 2013, right? The word tokenization didn't come up anywhere, but we've been talking about it a lot. So again, I like to go back to first principles. What do we mean when we say tokenization? A token generally is simply something that represents something else. And in our space, that something else is probably something of value, an asset, okay? What a token is not the thing itself. A gold coin is not a token. A gold coin is the asset. If I transfer the gold coin, it is the asset. Now, if I accumulate a lot of gold, I have to put the gold coins into a gold vault. Why? Because they're heavy to carry around. And usually the gold vault would give me a ticket as a claim against the gold in the gold vault. And that ticket, that is a token. Okay, now jump forward 5,000 years, and here we are in today's world where our paper money in our pocket, those are tokens. They used to point to a claim against the central bank being able to redeem some quantity of gold. Today, that is no longer the case. It is a fiat system. It is based on faith. It seems to work mostly, right? We've grown to trust our central banks and our institutions. Now, the thing that I think tokenization of assets is going to bring is where we're able to represent all forms of value will no longer be merely represented as an entry in a database, which has your name and the amount that you own, like your bank account. It's got your name and how much you own. Your stock market account, it's got your name and how much you own. But it'll have additionally a whole set of programmability features. So we're going to represent all forms of value, all assets, as programmable digital objects. And that's what we mean when we say tokenization. Now, if we do so in a manner where those programmable digital objects are standardized, examples ERC 20, 721, 1155, then they'll be able to interoperate seamlessly and at very large scale. The buzzword for a high degree of interoperability that comes from the crypto world is composability. But it's just, it's a new way of saying highly interoperable. We'll be able to take tokenized assets and make them extremely interoperable with all other forms of tokenized value. And that should allow us to programmatically deliver all kinds of interesting things, which we're beginning to see from DeFi. DeFi, more or less, there's programmatic borrowing and lending, and there's programmatic exchange. Okay, borrowing and lending's been around for a while, and exchange has been around for a while. But what they're able to do so is by adding this concept of atomicity, in that the lending or the exchange is done instantly and irrevocably. And in the world of mainstream finance, we would call those DVP, delivery versus payment, where the security is delivered versus the payment at a time of transaction, or payment versus payment, where the cash of one currency is delivered against another. But in today's world, those rely on CCPs, central clearing parties, or counterparties, CSDs, central securities depositories. And in post-trade lifecycle for securities, we've got all manner of paying agents and calculation agents and these intermediaries that now we can begin to see how perhaps we can make the financial system, through the power of tokenization, perhaps, if we're allowed by the regulators on public ledgers, far more efficient, resilient, eliminate potentially settlement risk, and with up to, as I pointed out earlier, 2 orders of magnitude greater efficiency than what we have today. Now, the truth is, if you were to ask me 5 years ago how long this would take, I would have said, yeah, it'll take another 5 years. And that was 5 years ago. Because these are regulated industries, we're going to see, I think, a long, slow burn for full-scale adoption in the financial industry of tokenization. And when I say long, slow burn, this is a 20 to 25-year journey that we're on. But I think the point I'd like to make as I close, for me, and this has been true since 2012, the destination is clear, and it is up to us in this room about how we get there. Thank you very much.
John, thank you so much for that insightful talk and for giving us that macro view. So thank you very much for that. Much appreciated. We're now going to move on to Amy. Amy, I think you're going to try to cover more of a US view on regulation and
PayPal's US view. And actually, I'm going to use the podium now.
Sure,
That's okay.
by all means, please do.
Good afternoon, everyone, and thank you, Jita and Ernst & Young. Really appreciate the opportunity to be here. And what I'm looking forward to talk to you today is about PayPal's vision for blockchain technology and also the steps that we're taking to help get us there, and largely from a U.S. perspective, because we're headquartered in the U.S. and that's our largest market. So, I think to begin with, at PayPal, we're a payments company, right? So that's the lens really we're bringing to blockchain. There's lots of other things we've heard people talk about throughout the day. But for us, it's all about payments and facilitating payments and digitizing payments for the future. So just kind of some background as a company 25 years ago, we spent time developing digital payments that are faster, cheaper, and more consumer friendly. Today, we offer a portfolio of payments through our PayPal, Venmo, Zoom, Braintree, a number of brands that help to digitize in all of those different payment verticals. And then as a global financial services provider, we realized that much like we helped evolutionize global commerce by moving payments from offline to online, we could help create a more accessible, inclusive, and efficient financial system by moving payments from online to on-chain. So just to step back a little bit, looking at what are our strengths as we come to this venture. You're used to payments, when people use PayPal and Venmo, they're used to payments that seem to occur instantaneously, whether between friends or to a merchant a half a world away. But underpinning that technology are rails that have been around for some time, like ACH or wire transfer, that were designed when we may have done more transactions in person or when we mailed checks through the mail, So today's consumers and merchants demand payments that can keep up with their needs, settlements that happen in minutes, not days, like we've heard about throughout this afternoon. Payments that don't stop when the banks close for the night or when institutions close for the weekend, that can facilitate interoperability and programmability, and that are accessible to anyone at low or no cost, whether they're a PayPal or Venmo customer or not. So now, fast forward, PayPal and Venmo offer cryptocurrencies on our platforms. How did we get here? Our journey started years ago, much like others do, where you start to research and you hire some folks to research and develop in this space. And then in 2020, we began offering 4 different types of cryptocurrency that were commonly thought of as currencies: Bitcoin, Bitcoin Cash, Litecoin, and Ether. And these were offered to better enable our US customers to buy goods and services. In 2021, we expanded that to our US customers of Venmo. But still keeping our payments vision in mind, we went through the next step, which is enabling our customers to use checkout with crypto. The way we're able to do that is to enable our customers to buy and sell goods at any merchant that PayPal supports. Customers can use the crypto that they hold in their wallet, and then we on the back end convert that to fiat, and the merchant sees the fiat. And if you use that service, our fee is waived. Again, looking for some of those cost efficiencies. And then we later enabled the ability to buy, hold, and sell crypto, just those key functions in Luxembourg and in the UK. So as you can see, our journey is incremental, but also methodical, as we seek to ensure that our customers get what they expect with a brand like ours, but also that we ensure that all our obligations as a financial services provider are met. Our goal has always been to help spur an environment fit for payments. So thinking with that in mind, and thinking about some of the challenges and volatility that some of these cryptocurrencies have, we launched stablecoin, PYUSD, in August of 2023. We made those available to our US customers to offer a more stable source of value for digital currencies and payments. So some things about PYUSD. It's an ERC20 token issued on the Ethereum blockchain. It's designed to contribute to the opportunity that we've talked about earlier today that stablecoins offer for payments. It's fully backed by US dollar deposits, short-term US treasuries, and similar cash equivalents, and can be redeemed 1-for-1 for US dollars. Reserves are segregated from corporate funds and held for the benefit of PYUSD holders by a regulated trust company. This means that anyone who holds PYUSD can always instantly redeem it with us at the same value as US dollars at no fee. We also bring our 20+ years of AML, KYC, and anti-fraud experience in payments to this space, knowing that a payment is more than a transaction. There's a lot more that goes into payments that we hope to leverage our experience to achieve. And we also use blockchain analytics partners like Chainalysis and TRM Labs to monitor transactions for illicit or fraudulent activity. and we have the capability to freeze and seize assets used illegally. All of this was done with the appropriate authorizations from our regulators. In the US, we look to the most rigorous regulator in the space, which is the New York Department of Financial Services, who's been overseeing the industry since 2015. The DFS, as you probably know, has a comprehensive framework for cryptocurrencies generally, and also for stablecoin issuance and the reserves that are required. We have a BIT license with DFS and a money transmission license with them and around the United States. And our partner that serves as issuer of the stablecoin, Paxos, is a regulated New York trust company. Our goal with the PYUSD is to make available to consumers, merchants, and developers and creators, make it more easy to connect fiat with digital currencies for payments. And as the only stablecoin that we support on our network, we leverage our decades-long experience in payments at scale. PYUSD is also designed to reduce the friction for inexperienced payments in virtual environments and facilitate fast transfers to support friends and family and through remittances. So I can give you one example there, and then another example on utility. So just a few weeks ago, we announced that Zoom, our money transfer business, enabled customers the ability to use PYUSD to fund remittances around the world. We serve about 160 markets. And if you are a US customer, you can fund your remittance. We convert that to the fiat and then send it to the local destination. If you use that service, we waive any Zoom transaction fees. So enabling US users of Zoom the option to fund cross-border money transfers just continues to build on that goal of bringing more utility to crypto, to stablecoins, and to chip away at achieving lower costs for remittances. And then the second example I'll give is PYUSD being used in the B2B business-to-business markets as well. Not too long ago, we announced that our PayPal Ventures arm was funding Series A funding for a digital asset startup called Mesh. And almost all of our investment in that company was in PYUSD. That transaction settled in minutes with low cost. So let's talk a little bit about the US framework and why we chose that. I mean, first of all, we're headquartered in the United States. It's our largest market. That's where our largest customer base is. So we certainly look to that first, although we're certainly mindful and well aware as a global company of all the activity that's going on with MiCA, with the UK, and in APAC, as we've talked about earlier today. But in the US, it's a unique framework. And I know that we had a graph up here, but I just want to break that down a little bit. Currently, the states regulate crypto, typically as a form of money transmission. And at the federal government level, FinCEN, which is our FIU in the United States, regulates crypto for anti-money laundering and counter-terrorist finance purposes. So there's a dual track regulation, one on the kind of oversight and consumer protection and governance venue, and then the other for illicit activity. And so for that reason, we went for our most stringent regulator in the space and the most stringent one in the United States that was available to us, which was the Department of Financial Services. There are several pieces of legislation in the United States that are seeking to build a federal framework, much like you're seeing around the world. One of those was passed in the House last year to build a framework that would allow different paths to authorization in the United States and develop a kind of a level set what would be required for stablecoins, both in the reserves and asset management. Likewise, there's another piece of legislation that's looking to oversee crypto trading markets, whether at the SEC or the CFTC. Those are still working their way through Congress. It's a pretty divided Congress, as you may have seen in the press. So we'll see if a number of things can come together to make that a reality this year. And if it's not, this isn't going away. We'll see more there. And then I think in the absence, just one thing I'll mention too, in the absence of any federal legislation, we're seeing the states step in. And so New York has its BIT license. California just last year enacted a crypto regime for California companies, or companies doing business in California, and you're starting to see pockets of that state by state. So in conclusion, we're very excited of the potential for cryptocurrencies have in the payments space, and particularly stablecoins, and we look forward to helping further grow that market. Thank you.
What's lastly we're going to be talking about maybe
Yep. If you could switch that on, if so that we don't. It's on. Cool. So, ladies and gentlemen, thank you very much, Amy. We're now going to hand over to Nicola from Visa, who's going to talk us through a little bit about what Visa strategy is in this space, what Nicola and the team have been doing in his role looking at commercialization and go-to-market for Visa.
Thank you so much, and I'll probably prefer to sit if that's okay.
Absolutely fine.
So first of all, it's a great pleasure to be here today. Thank you so much for giving me the opportunity to be here and represent Visa with such esteemed panelists. And I will use the time and talk a little bit about, first and foremost, how we look into the space, what makes blockchains and digital assets, crypto, an interesting area for us to explore. Then I'll talk a little bit about what are some of the key areas that we are working on right now. And then finally, some of the early kind of product development that we are doing in the space. Now, at Visa, we look to add value to all forms of money movement, and blockchain and crypto space is no different in that sense. We are working with companies across the payments ecosystem, and we also work with a number of players who are representing crypto and the blockchain ecosystem. When it comes to like our focus and strategy in the space, it really boils down to being this bridge between exciting new platforms and kind of applications built on them, including the blockchain networks themselves, and connected them to our existing network of 14,500 plus financial institutions and I believe over 130 million plus merchant endpoints. And effectively, we see digital currencies running on blockchain networks as just another set of networks similar to ACH or RTP networks in a representation of our network-on-network strategy. Now, we definitely see blockchains entering the what we call the broadband era, and I think as we moved from dial-up to broadband internet, you have seen a great improvement in first and foremost the connectivity speed, scalability, and ability for companies to offer interesting products and solutions in the space. And as I think as we've seen in some of the earlier presentations, very interesting stuff from Paul around what you can do now on some of these blockchain infrastructure. We have definitely come to a point where blockchains have been improving quite significantly the last number of years, and they've improved their scalability, efficiency, and ability to process more and more transactions on a kind of per second basis. This leads potentially to like a great and kind of growing application of consumer-facing propositions that can help improve some of the existing services that are offered in terms of payments and money movement. And it's fair to say that we see that there is great potential in commerce, financial services, payments, money movement, but there is probably like a great other collection of industries that not necessarily are kind of part of our purview, as we seen earlier in supply management, and as we heard from Laura Mary and some of the other applications. And definitely, crypto is a collection of technologies. From our perspective, the two most important innovations are blockchain networks and tokens. And blockchain networks, as discussed previously, are effectively a single source of truth ledgers that allow a number of participants on those networks to exchange value or information. And that in some ways, if you look at public permissionless blockchains, are not owned or kind of owned on behalf of just one entity. And tokens are just lines of software code running on this network, enabling participants to exchange value or information. And they can be fungible in the form of Bitcoin or dollars or other such tokens, or they can be non-fungible. They can be real estate, they can be gaming assets, they can be art. And interestingly, why are we talking about this? Well, today's digital economy runs on thousands of independent ledgers, which separately kind of store in records of who owns what. And blockchains have the potential, alongside with tokens, to actually allow much faster and more interconnected ways of building propositions for consumers and businesses, the whole ecosystem. Now, we're still at the, I would say, the relatively early stage, and there needs to be a number of incremental improvements that will abstract some of the complexities of using the technology to effectively realize some of the use cases. And starting with the technology itself, it needs to be scalable, but it also needs to be reliable and secure, especially if you're looking to start building applications which will generate thousands, millions, or even billions of payment or money movement flows on an annual basis. Secondly, there needs to be a trust from consumers in these applications and networks. Now, they don't necessarily directly interface with the networks, but they need to trust the applications using to access these networks and execute some of the features that they're looking to do, maybe send funds or exchange assets. And then, very importantly, there needs to be a degree of interoperability and a degree of effectively moving seamlessly value across different blockchains. Now, there are many different blockchains and there is a growing number of blockchains on an everyday basis. I sometimes struggle to see it. Actually, if somebody asks me how many of them are there, I don't actually know. There's quite a few. Maybe there are a few that are more significant than others, but they're built, to some degree on slightly different stacks, slightly different architecture, slightly different compliance, and having a way to seamlessly move and exchange value or transfer assets between these blockchains, maybe even between public and private blockchains in the future will be increasingly important. And then, of course, from a consumer perspective, they need to have some form of ease of use, but also the way that they can trust these networks such that in the case they get frauded or that they do a wrong transaction, there are ways for them a recourse against those actions and an ability to recover the value. Now, all this lends to very kind of interesting future applications that are being built. But what we are focusing on mostly now, I would say first and foremost is looking into on and off ramps. I heard that discussion previously, but for us, on-ramp is effectively moving from fiat to crypto by using your Visa credential. And this is the core of what we do as a network, connecting buyers, consumers, and merchants, and enabling a seamless exchange of funds such that the consumer can purchase a good or service in a secure, resilient, and reliant way. And we see crypto just another merchant vertical that we are always looking to support and optimize for the ecosystem. In the same way, for us, off-ramp is the ability to effectively move away from crypto and into fiat. And there are a number of ways you can do it using our network. One of them is to effectively cash out your holdings of digital assets and then use one of our payout capabilities to transfer funds to one of your existing accounts and then spend in the real world. Or you can generate higher utility of your existing holdings by effectively attaching a Visa credential to it and having a crypto-linked card, which then allows you to spend the balance in real time in real world. You can go and buy a cup of coffee. You can buy a ticket, a train ticket. You can go and buy something on one of the marketplaces, or even purchase a dinner for you and your wife or your partner. So effectively, on and off ramp is at core of what we do, and then we're also looking at other ways in which can add value to our clients, and we have value-added services, specifically our Visa Crypto Advisory Services, which is part of our Visa Consulting Analytics division. And there we work with financial institutions and retailers. We're looking to see in which way can crypto effectively add value to their existing products and propositions, or in some ways it can also help them service some of their unmet needs. Now, on the product side, one kind of initiative I'd like to highlight is the work we're doing on digital currency settlement. And this is an early initiative. We're looking for ways to enhance and improve potentially our existing treasury infrastructure. And in a way, as today, I think we allow transaction in 160 plus currencies and settle in over 25. We want to add capability to settle in the future in digital currencies over blockchain networks. And this is something that we've been working on for some time, but as mentioned, it's at a relatively early stage. Secondly, I would like to highlight the work we are doing on tokenization, specifically with the work in Hong Kong as part of the Hong Kong Monetary Challenge. And now, tokenization is a very broad topic, and I think if you ask all the people in the room, they will give you a different explanation of why this is important and why we should be looking at that. But I would say that definitely there is a way that it can add value, and has been proven by Santander and John's team, who've been doing a lot of interesting experiments, and also by PayPal with Pay by USD. You can tokenize securities, you can tokenize bonds and equities, and effectively with that you can maybe slice and dice them into smaller component pieces, effectively democratizing access for larger group of investors, individuals to participate, and making them more liquid at the same time. I know that we had a negative opinion about tokenizing real world assets, but you can still do it and tokenize a building or Van Gogh or maybe some other piece of art. I mean, I have different tastes, but whatever people like. And with that, you effectively make a very liquid vertical, potentially a lot more liquid, by first and foremost making it smaller and more affordable for some people. I can't buy Van Gogh, for example, but I would like to fractionally own one. And also at the same time, you make it more liquid because you effectively are making more liquid assets in smaller component pieces and now being available to be traded potentially in 24/7, 365 networks. And then finally, you can tokenize fiat or tokenize cash. And with that, you have effectively using some of the benefits on the blockchain networks, like always on, 24/7, 365, ability to kind of near instantly, or depending on the network, maybe take a few more minutes to settle and kind of exchange value between participants. At the same time, you're also anchored to like a fiat currency, generating benefits of a kind of very stable fiat currency. Now, as part of the work in Hong Kong, we work with HSBC and Hang Seng Bank to showcase some of the ways in which potentially combining a wholesale CBDC, Hong Kong dollar, and a tokenized deposit, and see in which ways this can improve some of the existing kind of use cases and pain points that consumers and businesses face. I think some of the interesting parts was we managed to showcase that when it comes to settlement finality, you can work together between the banks, mint and burn tokens deposits at the same time, and use wholesale CBDC as a settlement layer to kind of reduce the settlement time and make it near instant or atomic, as people call it, and also kind of improve liquidity management. You also have a potential to exchange and execute some of the more kind of high value B2B transactions in a more seamless way. You can, for instance, some of them are not effectively suited for RTP network, but you want to execute in that manner. And as we have shown with the example of purchasing a property, you can effectively do that by combining kind of tokenized deposits and blockchain networks with some of the kind of standards issued by the government. And then finally, you can make this programmable. I mean, needless to say, there is a lot of benefits that banks and financial institutions can and are in some instances realizing when it comes to using the blockchains to automate some of the existing processes and practices. And also I would say another thing to note is we have shown that this can be really kind of always on 24/7, 365 infrastructure, as we've shown that some of these transactions were conducted out of the kind of traditional business banking hours and on the weekend. So with that, thank you very much, and that's all from me.
Thank you very much, Nicola. Thank you. So ladies and gentlemen, we've got a little bit of time for some questions now, either from the room or online. Before we go there, I've just realized actually I got pinged by my team to say I didn't introduce myself. I'm G. Chamarjit Singh. I head up blockchain for EY across EMEA, and really pleased to be here with you all today. And interestingly, Nicola, to the point you made about Web3, one of the topics we've been playing with at EY is analogizing markets to web. You had Web 1, Web 2, Web 3, and we've been playing around with the idea of Markets 1. For those of you old enough like me to remember when you used to write trades on a blotter, that was Markets 1. Markets 2, sort of what we currently have, centralized but not 365, 4 days a week type situations, fat pipes, etc. Markets 3 is the new world that we want to go into with 24/7 hyper personalization, tokenization, payment rails that work for us, etc. And I think that's actually what's really quite interesting for me. Now, nothing's appeared on the screen yet online, but happy to go with the room. Well, I've had two hands up right in front of me. Let's go to Paul first.
Thank you, Jeet, for organizing an excellent panel. So my question is for Amy, longtime PayPal user, big fan. I want to ask you the same question I asked Dan Seifert from Coinbase, which is, PayPal especially, you have tens of millions of customers, right, who all have access to crypto. You've done an incredible job of making it easy to buy and to hold. Do you foresee a future where PayPal will offer a curated selection of DeFi services to your customers as investment options?
I mean, it's hard for us to think about that. We're a CeFi, right? So but certainly, if PYUSD is issued on Ethereum blockchain, that is a decentralized protocol. So we're certainly looking at those ways, but I think it's kind of baby steps when you're a financial services company in a regulated environment. And so we're starting with things that, working hand in hand with our regulators, taking these kind of measured steps. So, I do think that is coming. I think there are the challenges that you have with privacy and AML and sanctions and things like that. So there's still more needs to evolve before the answer to that is clear. But it's out there, right? So we need to be mindful of it and aware of it, and it may bring some good things to financial services.
Before we go to the next question, can I just ask John maybe a slightly cheeky question to you, sir? Given it's Santander, which is a CeFi organization as well, could you see financial institutions with MiCA coming around the corner, starting to do what Paul just suggested?
I think as soon as there are clear regulations around DeFi, financial institutions will begin to take it seriously as a potential additional service offering to our clients. DeFi, more or less, the two big versions of the protocols these days. One is around automated borrowing and lending, which essentially is peer-to-peer borrowing and lending. Yeah. Prosper was the first peer-to-peer market launched by, actually, it was Chris Larsen, who later became one of the founders of Ripple. It was going back to 2006. And then the other is the AMMs, the automated market maker protocols like Uniswap, the aggregators like 1inch, etc. A lot of financial institutions, that's what we provide to our clients in our markets business, essentially our markets. Yeah. But they're not AMMs, they're order book markets. And there's a little bit of a challenge with AMMs in that that's where there's a whole new category of maximum extractable value that comes from the AMM style market that is simply not possible with an order book style market. There needs to be a bridge between the two. But once we see regulations for DeFi, I think then financial institutions will begin to explore the space thoroughly. Functionally, we all have teams that know how it works. But until we see regulation, I don't think we'll see real products in the market being fully deployed.
Right. Thank you. Question in front over here. Sorry.
Absolutely fascinated with the conversations that have taken place. Can you just, it's a question to the whole panel, how would you deal with chargebacks, which is very, very common in high-risk payment areas? And do you think the cost of high-risk payments, the interest rates that are being charged at the moment, will actually be reduced as payments become a bit more convenient for everybody?
Question.
All right. I'll go with interest rate. I mean, for chargebacks, we're looking at that. Right now, we would deal with them the same way that we do, because since we're centralized, we have the ability to offer payment protection for our customers, and so we can, our merchants are our customers and the consumers are our customers, so we would handle it very similarly, because the transactions occur within our own book.
Yeah, I would say we have kind of strict rules that govern how kind of chargebacks will be processed for different transactions. And just to piggyback on John's earlier point, as soon as there is more clear regulation on some of the kind of blockchain and crypto space, I think as it becomes clear in different jurisdictions, probably that's the time where we will probably be looking at that problem ourselves.
Yeah, I don't see the chargeback problem going away. Let's take a similar example, which is around APP, authorized push payment fraud, right? We have a responsibility to our customers when they say, hey, there was a problem, there was a payment made, or oops, I made a payment and I didn't really mean to do it. And you financial institution should refund me some months later. The regulators take a very strict view of these things in different jurisdictions. As much as we would like to say stablecoins and crypto, well, crypto particularly, are a form of digital cash, a cash payment, there is no chargeback unless the person you give the money to is kind and will give you the money back. Otherwise, it's gone, right? Same might be true with Bitcoin or Ether, but that is not going to be true with stablecoins that are on Visa networks, PayPal network, or similar across a bank, simply because from a regulatory point of view, we can't.
Question at the back over there in the room.
Hello, thank you for the panel. So I went to Michael Manelli's events quite a long time ago before he was the Lord Mayor. He kept me sort of sane during COVID because he would do lots of events online. He really knows what he's talking about a lot. He is only going to be Lord Mayor for 1 year because you have to change over after a year. Do you see your organisations working with the City of London Corporation, or like what do you feel is the relevance of that at the moment? And yeah, do you see yourselves working with that? Because now would be the time to do that because he is a very knowledgeable tech person, so now would be the opportunity to do that.
And maybe widening the question a little bit as well. There are other individuals like that around different countries at the moment pushing the same sort of agenda there, and being quite helpful to the industry. I guess in that wider sense, how do you work best with be it mayors, be it cities, be it countries that are quite keen to push the envelope in the way we've been talking about?
So we work with, number one, the regulatory bodies in a jurisdiction, not with any one individual, as inspirational or as transformational or as forward-thinking as they may be. And it's wonderful when they are. We've seen scenarios, for example, in the European Union, where there was 1 or 2 people that were behind the original architecture of MiCA. We know them well. Yeah. In Brazil, there are 1 or 2 people at the Brazilian Central Bank at senior levels that are, provocative thinkers about the future. But the truth is they're only there for a period of time. And that engagement with the regulator is a longer term thing and generally is coordinated through a governmental affairs department at a bank or our public policy team, etc. And we kind of decide on general themes. I'm guessing the same is true for Visa and PayPal as well, that we want to achieve in advance. I think it's wonderful to have these inspirational, technically proficient experts in senior positions, but inevitably it's somewhat short-lived because they're only there for a year or a few years. Hopefully they've been able to inspire their larger teams and bring the entire jurisdiction on the journey.
Anything else? No? That's cool. Oh, there's a question over there.
Yeah, thank you.
Next.
So I wanted to wonder about, since we all elaborated about tokenization of digital assets, etc., and we saw that there are some potential advantages that are brought by digital assets, for example, tokenized gold. Sometimes you can, for example, not pay custody fees, or as you mentioned for, I believe, PayPal stablecoin, that you're not paying a withdrawal fee. Do you think that we can go further in that dimension and there will be further capabilities available among the assets that have not been historically available beyond the typical blockchain benefits? I don't know, some cheaper costs, additional functionalities, etc. For stuff like real world assets. I don't know. Thanks.
Well, I think I'm quite happy to even talk about some of that. I mean, there've been quite a few firms now looking at things like real estate, right? Instead of a traditional SPV structure, and let's face it, a lot of what we're talking about for tokenization, you can do using current existing structures. They're just painful and expensive, right? With SPVs, or having to put all the legal agreements in place with CLOs, with various, there are different ways that can be done, but it's currently expensive. So what we're talking about is the ability to do that more cheaply, and with smart contracts as well, the ability to actually manage that in a better manner. So, if you are looking at a building currently, yes, you can have all the retail units in a sort of equivalent of a token and all the commercial units in another one and the ground rent. And yes, you can do all of that. But in a tokenization structure, you could probably do that far more easily. And with smart contracts, you could then align the flows in terms of returns far better. What I do, though, caution whenever, and I kid you not, at least every fortnight, someone comes to us at EY with a new idea about tokenizing some real world asset. We've had everything, but what I do caution a lot of people about, though, is please remember that just by tokenizing and fractionalizing something doesn't magically mean liquidity is going to appear, right? Yeah, liquidity is still a very different concept, right? Yes, you have made them smaller chunks. Yes, the smaller chunks might be easier for us to buy and sell, like the Picasso, or was it Van Gogh? Picasso, I'm going to get mixed up now.
I like Picasso better.
The Picasso example, right? Yes, it's smaller chunks, so it might be easier to find somebody who's going to pay you £1,000 or €1,000 versus 10 million or whatever, which is the whole thing. So you might have more marketability and therefore a little bit more liquidity, but at the end of the day, that still isn't going to magically appear, and that market needs to be there. And the other point I also point out to people is people are still going to have to set the price, right? So just doesn't mean that because you paid €1,000 for that token of a Picasso means that when you come to sell it, somebody else is still going to pay you 1,000 or more, because to exactly use the example of art, which is in the eye of the beholder, somebody else might have a very different view of that as well. So I think tokenization definitely is a great benefit, but I think we also do just need to be a little bit. To me, it's all about the efficiency and the ability, which becomes far easier to do in this space.
Jeet, you said an important word that is often forgotten about when people talk about tokenization of real-world assets. The word he said was fractionalization. You fractionalize a real-world asset, you're almost certainly into the realm of securities law in most jurisdictions.
Yeah.
Get your attorneys before you fractionalize, not the other way around.
Yeah, very good point. There was a lady over there, yes, with her hand up.
Hi, I probably a question for the whole panel actually. I think it was Nicola that mentioned trust and obviously the benefits, and we've all been here today and we all understand in this room the endless benefits of blockchain and how we can build trust around it. But how do we outside the room build that trust? So what needs to happen for whether it's an end consumer or whether it is wider industries to actually help drive adoption and demand in this area? Because obviously we know that it's gone over a number of different hype cycles with blockchain, and we quite often talk about this will come in the future, this is an opportunity. But what actually needs to happen for us to realize that and to actually make things change?
Brilliant question to close with, because that we are running out of time. So let's hear it from the panel.
Yeah, I'll be quick. I would say two things. One is regulation, definitely, but not regulation in specific jurisdiction, but regulation in a number of different jurisdictions globally, such that you can make global consumer-facing or business-facing propositions. And number two, definitely improve UX UI. We've made great strides, but something needs to be so simple that your parent can use it, that your partner can use it, somebody who's not connected to the space at all, without you explaining for 15 minutes how to use an application or how to store a phrase and what happens if they lose the phrase, etc.
Yeah,
I would say the same thing. Those incremental use cases that they're tangible. The people are actually using a lot of what we've talked about. That's what we're trying to build, but some of them are big, or some of them are between major institutions, and once the individual person uses it on a day-to-day basis or in a very convenient way, that, like you said, you don't have to explain, you just use it, that's what's going to start to build. Not a huge use case where you just think you flip the switch and the whole thing turns on. It's very difficult, especially in financial services.
And for tokenization of securities at scale, we're going to need participation from the global custodians that we have in traditional securities markets. It's obligatory to happen. They're moving slowly, but they need to move. If anybody is here in the room from a global custodian, please take that as a strong message. Thank you.
There were definitely a couple of people who are in the room who are from Global Custodians. I shall not point them out, but they are definitely in the room. And I think the best example I had from someone to that question as well was where we use the technology and we don't realize we're using it, right? To me, that's when actually we've got there. It should just happen underneath and just happens ubiquitously, so it just makes things happen without us realizing, and that's when we've got success. Ladies and gentlemen, 10-minute comfort break for you all. Please, teas, coffees, etc. outside, and please be back in 10 minutes later for our last session. Thank you very much.
Thank you.
Thank you.